Hi everyone, Tim here, along with Billy from ProsperUS, and we are going to be just giving a quick recap of the markets in Singapore over the past week. So Billy, what have you found interesting about the Singapore stock markets over the past week?
Hi, Tim. Yeah. So it's been a pretty good earnings actually this round, if you ask me. I think that most of it are either better than expectations or in line with expectations.
Mm,
Personally, I just wanted to highlight some of the companies that we've been really looking into. So, for example, I think we've been looking at some of the retail play like Sheng Siong. I think we've talked about it before, that this transition to normal, where people will start to going out again, and how that will affect them. So we saw that in this quarter where revenue growth actually moderated. So I think that's in
yeah.
line with expectation. But what's really impressive is how they managed to continue to maintain the margin.
Mm, yeah.
Yeah. I think we mentioned this before, that Sheng Siong has a good track record in terms of maintaining margin, and of course with what we see today, the rising inflation and how they managed to pass the cost on to customers. I think that just continue to play to their strength as a value buy for retail shoppers. So I think that
Yeah.
really plays into Sheng Siong's strength.
Yeah. As an interesting point about margins, I think that's the similar case for Venture Corporation, which is a technology firm based here in Singapore that does a lot of manufacturing for the likes of Philip Morris and life sciences. And they released their earnings, I think, a couple Fridays ago, and they also maintained their margins against expectations. So that kind of shows that they're able to pass on these costs to customers. So I think the ability to defend the margins shows investors that these companies have pricing power, which I think, as you said, is key in this inflationary environment. And so with Venture's own earnings, they have a lot of manufacturing facilities in Malaysia, not that much in China. So I think they've managed to sort of mitigate the whole supply constraint, logistics, supply chain constraints. They've managed to manage that quite well. And they also have a pretty good net cash position. So they've done slightly better than expected. And they're yielding about 4%, 4.1%. So, I think for dividend investors, they will be happy with those set of earnings.
Yeah. I mean, I guess if you talk about dividend investors as well, I think even the rates in Singapore, I think most of it are pretty decent. I think the results that came
Mm,
out. I like the fact that the dividend yields at most of them average at still around 5%. I think
yeah.
so it's quite interesting, despite we talk about rising inflation and how that would actually, the rising interest rate environment and all those how that will actually affect some of the REITs players, and so far things have been pretty positive lah. I mean, if you
Yeah.
compare I think Singapore with the rest of the market, I think Singapore is probably the second best in the region after
Mhm.
Jakarta Composite Exchange.
Yeah.
So that's cool. That's quite a positive thing for the Singapore market.
Yeah, I think they've REITs have performed pretty much in line with expectations for the Q2 and first half of the year. But I think obviously there was some of the retail REITs and commercial REITs have started to benefit from this opening up or continued opening up of Southeast Asia and the Singapore economy. So the likes of CapitaLand Integrated Commercial Trust, Fraser Centrepoint Trust, some of the industrial REITs are coming back into favor as well. And so I think, yeah, these yields are pretty solid in the ranges of 4.5% to 5.5%. So I think for investors, they're quite happy to just pick up that yield and continue to hold these names.
We have not really seen the rising cost of operations affecting the margin for the retail REITs player, right?
Yeah, not really. Yeah, I think they've been managed. But also I think rental reversions have also been pretty positive for a lot of retail REITs. They're coming out of obviously a really terrible pandemic period, but rental reversions across the board have been pretty good. So I think that's another argument for REITs, is that they can actually, if they have quality assets, they have pricing power in terms of rentals. So they can effectively raise rents in line with inflation or above inflation. So I think that's something that a lot of REITs with larger portfolios have been able to do. So I think in this environment, the large REITs, the ones with scale, have really benefited.
Yeah, and in terms of the banks, which are you happy with the earnings results so far?
Yeah, so I think the banks all came in above expectations. They really did well with net interest margin expansion, net interest income expansion. So I think we're at the early stages of this playing out. Obviously, the Fed has raised rates quite quickly over the past 2 or 3 months. It's up to what 2.25 to 2.5%. There's probably going to be another 50 basis point or 75 basis point raise next month. So I think this is going to be lagging, right? So they'll be able to see more of that effect of the rising rates come through in the third, fourth quarter of this year. So in terms of the best set, I think OCBC did particularly well. But in terms of the actual size and the leverage just towards right raises, I think that DBS has probably got the most upside to it because it's got the biggest loan book as well. How about yourself? What did you think about the bank results?
Yeah, I'm actually quite happy with the results. Just that I think there's the concern in terms of I mean, people talk about the potential. I think actually US already in a technical recession, but if they were really to fall into a recession, how that would actually affect the banks in Singapore. And I think that's something to watch out for. I mean, at this point, I don't see any indication that things are going to be that bad. But it's hard to say if the Fed will continue to raise rates at this level.
I think a lot also relies on China, right? Because of the exposure of OCBC, UOB, and DBS, particularly DBS and OCBC to China and Greater China. So, the zero COVID policy there, China's slowed down. But if there is a recovery in China or there is a reversal of that policy and growth picks up, then I think OCBC and DBS could really be exposed to the upside on that. But then on the flip side, there's also the danger of a slowdown or a major property or debt crisis in China. So there is those risk factors that we have to watch out for the banks.
Yeah. I think for China, it's a bit, there's a lot of uncertainties. I think we have a house view, have quite a positive outlook on China. But I mean, personally, I think that there's a lot of question marks because of the lack of transparency and a lot of things that we do not know about China in a sense. So I think that's really going to be I think it will really drive both ways depending on how China manage the COVID situation.
Yeah, no, definitely. I think it's going to depend a lot on the outlook for 2023 as well, because I think most people are expecting the Chinese economy to remain closed for the rest of this year. So I think how they signal the reopening, if it comes in 2023, I think is going to be important for market sentiment on China. So I think that's something to watch. But I think overall it's been a pretty good earnings season for Singapore companies. So thanks for joining me today, Billy. And maybe we'll catch up. We'll catch up next week, and we'll be keeping investors in the loop with the hottest topics. So bye for now.
Okay.
Thank you. Bye.